I'm Jen Rogers, and we are here to talk about sustainable investing in the energy sector. Before I introduce our panel, I want to remind all of you to ask questions. We want to hear from you. You don't want to just hear me asking questions. You have the really good ones, so put them in the chat for us, and we will try to get to as many as we can. We also have a poll in there that I would love for you to go and take, trying to address what the biggest impact that you've had when you've been evaluating some ESG investments. So go take that poll. That's also going to inform our conversation as well. We will go through the results. So let's bring in this panel. It's a good one. Today, I'm joined by Vice President of Investor Relations at Williams, Danilo Juvane, Energy Income Partners Principal and Senior Research Analyst Lou Lazzara, and DWS Equity Analyst Hanchen Wang. Thank you all so much for being here. And Hanchen, I want to dive right in with you and talk about how the energy investment story has evolved in the last few years as it relates specifically to ESG. What have you seen?
Great, thank you. Thank you for the kind introduction. One big question that I think for us as sort of a very international and sort of investment manager, sort of the question that we've faced is that many of our international client base have been thinking very seriously about the question of environmental sustainability as a key pillar of their investments for the next foreseeable future, right? With Europe looking towards going towards a regional net zero policy, with many Asian countries also committing to sort of net zero energy policies over the long term, investors want to align themselves with this theme. And so for them, the primary debate that I think a lot of them have come up with is the question of how do we maintain a high energy intensity economy and high energy intensity businesses while reducing carbon intensity. And so a lot of the important questions, and I think very interesting questions in investing, as well as looking for profitable businesses going forward, has been trying to find sort of the middle ground solution, right, to increase the energy intensity, to increase the prosperity of the economies in which these companies operate, but at the same time trying to address very, very difficult questions in terms of reducing the carbon intensity and reducing the environmental impact of those businesses. Obviously, the war in Ukraine very recently, sparking energy crisis in Europe, has sharpened the focus on what it means to try to pare back how much carbon intensity you can pare back from our basic residential and sort of personal use, right? So there's a wide range of issues sort of that have kind of come up to the forefront over the last 2 or 3 years that have sort of changed and challenge the notion of what it means to have sustainable investments and still be profitable over the long run.
I mean, I think that really sets out the core question here that people are wrestling. And Lou, I'd love to bring you in at this high level before we dig down deep on some of these issues, like what we're seeing in Ukraine. But how do you square the E of ESG with energy? I mean, how do you evaluate that?
Sure. It's the ESG is very interesting in the sense of, it's been around for a while, but it really came into its heyday back in 2018, 2019, as a lot of capital got attracted to the space. And there was, within the ESG realm, there was a lot of focus on the E part of ESG, right? The environmental aspect. And so, we are energy infrastructure investors. Half our portfolio roughly is in electric utilities, which have, in the US at least, have driven, 80% of the carbon reduction over the past 15 years, essentially converting coal plants into natural gas and renewables. The challenge there, though, is it's not just about cleaner energy, it's also about reliable and affordable energy as well. And that's the S and the G part of ESG, right? The social aspect of it. You can't just have clean energy, it's got to be affordable for all as well. And that is sort of, I think that's been the challenge, and that's where the dialogue, I think these days, post sort of the energy crisis out of Russia, Ukraine, as energy prices have spiked, folks are focused on, okay, it's this transition needs to be just as well. And how do we navigate through that? So I think that's really where the crux of the conversations have been around.
So Danilo, let's bring you into this conversation because you sit at a different vantage point than both of these guys. So how does an energy company like Williams be sustainable? How are they part of this narrative? And when investors come with ESG goals, how do you fit in?
Yeah, that's a great question. I think at Williams, we really do think that sustainability is synonymous with our operations, right? Lou mentioned some of the benefits that we've seen from a greenhouse gas reduction standpoint within the utility sector. As a natural gas pipeline company, we've been the largest contributor to providing that natural gas to utilities to afford them the ability to reduce those emissions from converting from coal power generation to natural gas power generation. So we do fit in quite well, I would say. We do think that natural gas is one of the cleanest fuels out there to really facilitate, at least today, emissions reductions. So we do try to strike a balance. At the end of the day, we want to make sure that we are doing what we're doing within the realm of a core business and still generating profitable returns for our investors. So it's about striking a balance. We think we fit well. We think natural gas is going to be that bridge fuel, or that fuel with the probably longest runway in terms of longevity. So we think we fit quite well, and it's just a matter of us continuing to do so in a responsible manner, and certainly in a way that still provides returns for our shareholders.
So Lou, both you and Hanchen mentioned the Russian invasion of Ukraine, the European energy crisis. So let's just focus on that for a second, Lou. And how has that impacted discussions around ESG and energy globally in a way that those conversations weren't happening before? Like, really fundamentally, what has changed in this last year?
Sure. I think the largest change is sort of the there's really been a paradigm change around folks' acceptance for natural gas and nuclear, actually. In Europe, there's a big push away from nuclear, and natural gas is sort of viewed as not clean enough, and folks really weren't. You saw there's in terms of like LNG imports into Europe, there was very difficult to get contracts signed into Europe because there was a lot of political pushback from signing contracts, because people viewed it as, hey, I don't want to sign a 20-year contract for natural gas. We don't want to use this after 10 years. Fast forward, from 2019 to 21, 22, and Europe changed its taxonomy to include both nuclear and natural gas as clean, right? As clean technologies. And I think that's really been the bridge for it, right? Natural gas, it's in order to have greater renewable penetration, renewables are intermittent. So you need some sort of base generation to keep the lights on when the wind isn't blowing and the sun isn't shining, right? And you need to do it in a more affordable way. It's battery storage technology, right? It may be good for 4 or 8 hours, but it's not good for long duration, right? And that's where sort of higher energy density applications like natural gas and nuclear come into play. So I think that's been a really big change on those two fronts.
And Hanchen, I want to give you a chance to address this as well, because you raised it, and kind of just to frame it around how you kind of evaluate companies right now in this current landscape, and given the changes that we've seen recently, the complexity of it, I guess.
Yeah, thank you. So, one very big question for us is that, many companies sort of have tried to align themselves with these themes, not only, as Lou said, right, sort of by, kind of trying to provide the kind of energy that, Europe now realizes that they want, that they prefer. But many of them have also been making investments into and sort of emerging technologies, right, emergent ways to deal with the carbon, the carbon load of their businesses, or align themselves to sustainability questions in other ways too. And so one very important framework for us to think about is, what is a reasonable return parameter for those investments, right? Obviously, when we're investing in publicly listed companies, we're not necessarily looking to fund private equity type or venture capital type, sort of technology exploration. We prefer to be investing as infrastructure investors in well-established, well-understood cash flows, preferably within a regulated rate-based structure. However, these things are not well understood in any regulatory construct, right? So for us, in evaluating these companies and evaluating these investments, it's a bit of learning there, right? For us, we have to go back to school and learn a bit of basic science in that sense, and try to understand and, in a sense, pick winners and losers to see what will best be aligned with the regulatory structures of the future.
So again, I want to remind everyone, take the poll, because we want to talk about that here. And also, I do see some questions that are coming in, and I will get to those. I want to, though, before we do that, talk to Danilo one more time about on the company front. And it's really interesting time right now in terms of what we're seeing politically, at least in the US, right? We've seen some Republican leaders targeting investors for pushing companies to make ESG disclosures and climate commitments. How are you seeing that political attention at all have an impact on what companies disclose or how investment decisions are made?
Not yet, but it certainly is moving in that direction. We basically do what investors want us to do today. The political arena is sort of something that we can't necessarily control, but it does ultimately filter into and will filter into what our investors are able or not able to do. Today, if investors are asking for disclosures on the E as part of the ESG framework, we do our best to disclose those, right? That may evolve into more disclosures on the S, more disclosures on the G. We'll try to kind of move along with the investor demands, right? So politically, we are seeing that push. Certainly, we are reading about it, we're keeping track of it, but we haven't necessarily seen that impact us today quite yet.
While we're with you, we're actually getting a question in here from Trey Cowan, and it is a question about Williams and Danilo. I don't know if you can address this, but saying that Williams is offering a product to tag molecules as lower intensity using blockchain. So could you talk about the verification process to understand which producers are producing lower CO2 natural gas streams? And even if you can't address that exactly, I think it does go to the fact that investors are trying to figure out what are the metrics, like how do I really make this decision? How do I know what's happening here when I'm making decisions? So is that a question that you could
Yes, I can definitely address. Like it's a novel field. We're all trying to figure this out as the journey progresses. I will say that with the blockchain technology through our new energy ventures process, we are trying to tag the natural gas molecule to see where there's some fugitive emissions within the natural gas value chain. Now, this is very unique, new technology. We have seen some areas where we need improvement in terms of emissions. So we're trying to be at the forefront of this kind of movement to be sure that we are addressing, again, the requires and demands that investors have out there. So we have, in fact, targeted our ability to certify that zero emissions or that trackable natural gas as next-gen natural gas. So we're trying to come up with ways to make sure that we are providing correct information to investors and trying to be proactive in terms of what we see within our entire energy value chain from an emissions profile standpoint. So one of the things that a lot of investors don't really understand is that it's probably going to be the current energy companies that are best positioned to move along the decarbonization path, as opposed to some brand new magical technology that we don't quite know yet that will come in and immediately solve the world's problems. So if they work in concert with us, I think that they're having a better understanding that we need to work together to be able to get that solution.
Okay. Some more questions here having to do with future and sort of more creative answers as well. I do want to address what we're seeing in the poll right now. First of all, if you haven't taken the poll question, go take it. What's had the biggest impact on how you evaluate your ESG investments? The Ukraine invasion is just about 5%. The climate crisis, about 24%. Long-term energy sustainability is the clear leader here, 58%, and about 14% haven't considered yet an ESG investment. So, Hanchen and Lou, I'm not sure if either of you have an opinion on this, both of you. There's a bunch of questions in here that kind of have to do with this transition and what we are seeing. We had a question on with electric vehicles growing, where do you see the global energy consumption going from 100 million barrels a day to what level in 10 years? And I'm just going to put a couple in here so you can get this sort of what people are thinking as you address what you're seeing in this space. A question about how does seaweed fit in, right? And then another one just trying to figure out the gravitational potential energy can be harnessed as a form of renewable energy, specifically considering old coal mines. How could they be used for this? So I think look, everyone's latching on to different pieces in here. I think it's really interesting to see though what people are thinking through. So I would be curious, since you are making investment decisions, you're talking to investors all the time, how you think about these issues that people are raising. Hanchen, do you want to go first?
Yeah, sure. Thank you. The questions that you framed for us, I think quite neatly falls into really the two big buckets of conversations that we do have with our investors, and a lot of our clients who sort of ask us these questions, right? One is on the demand side, where do we see the long-term demand? And secondly, where do we see the sort of the supply of energy, and what does the picture for that supply of energy look like? And on the demand side, you can sort of dig into a little bit deeper to ask two questions, right? What is the demand for energy, and what is the demand for fossil fuels? So, for example, on the question of electric vehicles, that assumes still continued growth in vehicle-driven miles, in miles flown, and so on and so forth. That doesn't imply to us a reduction in sort of energy demand, but maybe it does suggest to us a decline, or at least a plateauing in developed worlds of crude oil. So obviously we subscribe to multiple research firms who give us multiple views on what the crude oil sort of picture looks like. But for us as energy infrastructure investors, what we care about really is just the movement of energy, right? What form that energy takes, we're somewhat indifferent to, and we want to be aligned with the best technology to sort of align themselves up with sort of the nature of the energy that is being consumed. And so from that perspective, right, we are incredibly bullish on where energy demand will be over the next 15, 20, 50 years or so, right? And then on the side of the supply question, it's really particularly interesting for us because this is one where we get the opportunity to talk to many of these companies who are trying to come up with new technologies, technologies to capture carbon, to sequester carbon. Seaweed is sort of one of those one of the carbon capture sequestration technologies that we've heard about a little bit as well. Gravitational potential, sort of as battery technologies, all alignments, right? We definitely do think that there is a lot of work to be there, and that's something that we're actively looking at. We're also looking at, for example, low carbon combined cycle generation. We're looking at nuclear power, looking at nuclear fusion. All of this fit very, very well into the core sort of thesis of infrastructure, right? The infrastructure of the future will have to be there to provide and sort of to supply the new mix of energy in the future. And, for us, I think a lot of the value there is to be early, right? To join in and to participate with many of these new technologies on the mezzanine level and see them grow and take up a growing share of energy, right? It's a reminder that energy in sort of the US alone, right, has changed so much over the last 100 years, from the whale oil revolution to the shale oil revolution, right? So, we like to think of ourselves as sort of always just aligning and trying to pick a diversified portfolio of energy companies, some of whom we hope will be the winners of the future.
Yeah, but we've modeled out the global fleet because we get this question a lot. And energy, as a rule of thumb, it's gotten lighter, in terms of energy density per GDP, global GDP, but it's still about half of the rate of global GDP growth. So if you're experiencing 3% annual GDP growth, primary energy demand is going to grow by about a percentage and a half. Right. So if the world continues to grow over the next 10 years, right, the question was around 10 years, then primary energy growth is going to continue to grow. At the same time, what people miss with EVs, EVs, the decarbonization of transportation, particularly passenger vehicle fleet, is probably the one area where the technology exists today and it's affordable, right, and it's getting cheaper. That is happening, right? We subscribe to that. The issue with the math, though, is that it takes about 25 years for a fleet to turn over completely, right? The scrappage rate's about 4% a year. And so in a world that continues to grow, right, even with EV penetration, we modeled it by 2030, half of all vehicles globally are electrified, and by 2035, 100% are. Even in that scenario, the way we model crude oil, it's still flat in 10 years, if not growing.
Yeah,
so that's what people miss.
There's actually a test case for Norway or Sweden, I believe, where they have the largest penetration of EVs, and crude oil demand there hasn't changed at all. It's been relatively flat.
Actually, yeah, and so that is the challenge, right? Is that so from our perspective, the new technologies, we watch them carefully. We, as investors, we're not investing in, in that more private capital realm, if you would. We're public equity investors, so we like to invest in the public utilities and the energy infrastructure companies that are sort of enabling that transition, but not necessarily out with the new technologies. So some of these questions around sort of seaweed, gravitational potential, those are all very interesting, right? But those are years out. And so if everyone believes the carbon budget and every year counts, then we need to start focusing on the low-hanging fruit out there, right? And it's basically a technology agnostic approach. And that's, I think, bringing it full circle to what you're seeing from a regulatory policy perspective. The IRA, while silly in name, has been great in terms of its ability to be technology agnostic and benefiting both renewables and traditional fossil fuel infrastructure in a way that sort of decarbonizes the economy.
I mean, it's interesting listening to you because there's a lot of excitement happening, but then it's also going to take a long time. It seems like, so in many ways,
Yeah.
it's this transition story away from carbon. And Danilo, where do you think we are in that story? Because I do think there's a lot of excitement sometimes, but what do investors need to know about the timeline?
No, absolutely. They need to know that energy transitions take about 80 to 100 years for them to occur. Within the renewables sort of framework, we're in year 20 at best,
Yeah.
right? So we're looking at another 60 to 80 years before this becomes sort of a very scalable option for a lot of people and affordable for a lot of people. So it just takes time. I mean, we've had investors really think that we are going to be a business that will be obsolete in 5 to 10 years. Our assets are going to go to zero. There's questions around the terminal value of our assets. Maybe our assets will be stranded assets with no value whatsoever. And that's not the case at all. This is going to be a long journey. Energy systems are very sticky. They take a long time to replace. So I think that once investors really understand the science behind it, they'll realize that it's going to take a while before we are in a world where you have a very de minimis amount of fossil fuels being utilized.
So
Yeah.
given that timeline, and we have a timeline too, we have about 2 minutes. So let's just whip around here. I just want to end with where you think the opportunities in the space are right now in terms of ESG for investors in energy. And let's go with Hanchen first.
Sure. If I could sort of give a punchline of where the opportunities are, I do want to take one quick step back, right, and to say that one thing that we think of as investors, as the one of the greatest strengths of American corporate dynamism is this notion that the thing that made you rich in the past isn't necessarily the things that will make you rich in the future. And the power of American corporations, as far as we've been able to see, right, as investors, is this not only the recognition and the ability to sort of adapt to that, but also the willingness to catalyze that. And so to us, I think the richest opportunities, the most interesting ways to make profits off of a sustainable investing future is to say that, look, challenge the areas where their existing status quo is sort of facing great degrees of pressure. I think what Williams is doing in sort of increasing sustainability by improving accountability, right? That's one particular angle by which you can offer a challenge to the status quo of a sort of a black box approach to energy production, right? Challenging the status quo and then sort of always incrementally looking for the ways in which you can be levered to the opportunities and to the prosperity of the future. And that's our view of where that lines up.
All right, we're almost out of time. So Lou, just a sentence or two from you.
Yeah, our view is energy infrastructure across public utilities that are sort of at the forefront of renewable penetration, and traditional fossil fuel companies that are enabling the transition through natural gas infrastructure are sort of the two areas that we're focused on and that we think offer very good returns.
And Danilo, you're going to get the last thought.
I'll just echo what Lou said, that we as companies in the energy sector are the best positioned to facilitate the transition going forward. So we need more allies and partners rather than enemies. So.
All right. Thank you all so much. Great questions in there. Thanks for taking the poll. Thanks to our panel. Really enjoyed all the time that we got to spend together. Have a great rest of the day.
Thanks, Jen.
Thank you.
Thank you.